Hey, welcome. So today we're going to talk about finance. And I know, that word can sound complicated, maybe even a little scary, but I want you to just push all that complexity out of your mind for a second. Because at its heart, finance is not about crazy math. It's just a way of thinking about the future. And it's all built on a couple of really simple, really intuitive ideas. Ready? Let's get into it.
Everything, and I really mean everything, in finance boils down to this one simple choice. If I offered you $1 right now in your hand, or a guaranteed dollar 1 year from today, which one are you going to take? The dollar today, right? Of course you would. It's almost an instinct. And understanding why that's our gut reaction, well, that's the key that unlocks this whole world.
And here they are, the two pillars that hold up everything we're about to discuss. First, you've got time. That's all about our preference for having things sooner rather than later. And second, you've got risk, which is just the plain fact that the future is, uncertain. If we can really get a handle on these two ideas, I promise you, every big financial decision out there starts to make a whole lot more sense.
All right, so let's tackle that first pillar, time. Why is $1 today worth more than $1 tomorrow? It all comes down to one word: opportunity. You can take that dollar today, put it to work, invest it, and earn interest on it. And that means you can turn it into more than $1 tomorrow. This idea is so fundamental, it has its own name, the time value of money. And to work with it, we need a special kind of tool.
And that tool is called present value. Honestly, the best way to think about it is like a financial time machine. It lets us take some amount of money from the future, any amount, and figure out what it's worth in today's dollars. This is so incredibly useful because it lets us compare different choices from different points in time. It makes everything an apples-to-apples comparison.
Now, how does this time machine actually work? Okay, don't let the formula scare you. The logic is actually really simple. You just start with the amount of money you want in the future. That's your future value, or FV. Then you basically unwind all the interest it would have earned between now and then. You just discount it back to today using the interest rate, R, and the number of years, N. It's just a clean way of figuring out how much you'd need to set aside right now to hit that future target.
Let's see this in action, because this makes it so much clearer. Let's say our friend Amaya needs $20,000 for grad school in 4 years. She's found an investment she thinks can earn 8% a year. Now, using that present value formula, she can see she doesn't actually have to save the full $20,000. All she needs to do is deposit about $14,700 today. Then she can just sit back and let time and interest do all the heavy lifting for her. Pretty cool, right? And that force, that thing that's doing all the work for Amaya, that is the absolute magic of compounding. It's this beautiful process where the interest you earn starts earning its own interest. It creates this incredible snowball effect. Over a long time, we're not talking about slow, steady growth. We're talking about exponential growth. It is without a doubt the most powerful force for building wealth. And speaking of powerful, here's a fantastic little mental shortcut so you can really feel how compounding works. It's called the Rule of 70. If you want a quick guess of how many years it'll take for your money to double, just divide the number 70 by the annual interest rate. So, at 7%, your money doubles in about 10 years. What about at 10%? Well, then it doubles in just 7 years. It's just a simple but super potent way to feel the speed of compounding.
Okay, let's pivot to our second big pillar. We've got a handle on time, but the future isn't just, in the future, it's also uncertain. And dealing with that uncertainty, dealing with that risk, is the entire other half of the financial puzzle. To really get risk, think about this. Imagine I offer you a coin flip. Heads, you win $1,000. Tails, you lose $1,000. Now, on paper, mathematically, that's a perfectly fair bet. But if you're like most people, you'd probably say, no thanks. And that hesitation tells us something really deep about human nature. Most of us are what we call risk-averse. So why is that? Here's the key. The pain of losing that $1,000 would probably hurt way more than the joy of winning $1,000 would feel good. Economists have a fancy term for this, diminishing marginal utility. But it's just a formal way of saying something we all feel intuitively. As you get more money, each extra dollar brings you a little less happiness. So that potential loss stings more than that potential gain satisfies. It makes us want to avoid the gamble. So since we naturally dislike risk, we've developed some pretty clever ways to handle it. The first one is insurance, right? You pay a small, known fee to protect yourself from a huge, unknown loss. Simple. The second one, which is absolutely central to investing, is called diversification.
And you've heard this a million times, and for good reason. It perfectly sums up what diversification is all about. Instead of betting your entire future on one single company, you spread your money out across lots of different ones. But, and this is super important, you have to understand what diversification can do and what it can. It is fantastic at getting rid of what's called firm-specific risk. The danger that one particular company has a scandal or makes a terrible product. But what it can't eliminate is market risk, the danger that the entire economy, the whole system, hits a downturn. That's a risk that everybody who's in the market has to deal with. And that right there brings us to the single most important trade-off in all of finance. It's this: if you want the chance to earn higher returns, you must accept higher risk. It is unavoidable. Stocks, because they carry that market risk you can't get rid of, have historically given investors much higher returns than super safe things like government bonds. As they say, there really is no such thing as a free lunch. Okay, so now we've got our two big ideas: the value of time and the reality of risk. So how do we put them together? Well, we use them to answer one of the biggest questions in all of investing. What is a share of stock actually worth? And the answer, beautifully, brings us right back to our first tool. The true fundamental value of any asset, a stock, a bond, anything, is simply the present value of all the cash you expect to get from owning it in the future. For stock, that means any dividends it might pay out, plus the price you think you can sell it for down the road. Let's make this real with a quick example. If we wanted to figure out the value of a share of AT&T stock, we'd estimate all its future cash flows, like, say, a $1 dividend each year and a sale price of $30 in 3 years. Then we just use our present value formula to pull each of those future amounts back to today. You add them all up, and you get a fundamental value of $25.03. Now, if the stock is trading on the market for less than that, it might be a bargain. If it's trading for more, it might be overvalued. Now, this whole idea of finding bargains and undervalued stocks, well, that leads us to one of the most fierce and fascinating debates in modern finance. If everybody has access to this information and can do this kind of analysis, is it actually possible for anyone to consistently find these deals and beat the overall market? So on one side of the debate, you have something called the efficient markets hypothesis. This theory basically argues that stock prices are always correct. Why? Because you have millions of incredibly smart, competitive analysts out there, and the very instant a new piece of information becomes public, the stock price adjusts. This means by the time you hear about a hot stock tip, it's already too late. The opportunity's gone. Now, the implication of this theory is massive. If the market is really that efficient, then trying to outsmart it by picking individual stocks is a waste of time. It's a fool's errand. You can't possibly know more than the combined wisdom of millions of other people. So the most logical thing to do is just buy a little bit of everything through a diversified portfolio and accept the market's return. But there is a huge counterargument. Other people believe that markets are far from rational because, well, they're run by human beings, and we aren't always rational. This view says that huge waves of psychology, greed, and fear, what the famous economist John Maynard Keynes called animal spirits, can cause prices to swing way out of line with their true value. This is how you get speculative bubbles and eventually painful crashes. And that leaves us right here with this fantastic final question. Is the market this cold, logical, calculating machine where all the prices are right? Or is it more like a chaotic psychological battlefield driven by emotion? Is picking stocks a science? Or is it really no better than just closing your eyes and throwing darts at the stock page? The truth, as always, is probably somewhere in the middle. And understanding that tension, that is what it really means to think like a financial pro.